Hey, welcome to Money Club Mondays. It's August 15th, 2022. And today we're going to be talking about private money lending and kind of what that actually means. Because I was visiting some family over the weekend over on the west coast of Florida, over in Fort Myers, Florida. And my brother lives over there, and I have a bunch of aunts and uncles and cousins. And so we had a big party for some of the cousins. My brother's kids, and then my sister. They live over on this coast, but they were over there visiting, and so all the kids have birthdays over the next month or so. So we had a little birthday get together, and everybody was together, and big huge thing. And but yesterday we were sitting around the pool, just kind of hanging out, and we were just talking a little bit about investing and money and real estate, and what kind of what I do, all day, every day, because it's kind of a if looking from the outside in, if you don't understand a lot about, infinite banking and real estate investing and private lending and stuff like that, it can be a mystery. We talk about that, the mysteries of money. And once you understand kind of the basics, I mean, is there anybody on here right now that, prior to doing private money lending or borrowing through like the private money club, for example, you didn't really know anything about it? Like, you're brand new, you learned about private lending and how to move money just from teaching us. I mean, from what we taught you, right? So it got me thinking, and so I just started telling them, hey, this is what we do. This is what we teach on the podcast, and they hop on and they listen here and there. But you know how it is with family sometimes, right? So so we got to talking, and they started asking me these questions. And it was stuff that, I kind of take for granted. Like, I feel like it's just common knowledge, it's common sense. But the more that I was talking to them and the more questions they were asking, and I started explaining things, by the end of it, they were like, wow, like, that's awesome. Like, why aren't we doing that? Why haven't we started, listening to what you teach and doing a lot of this stuff? And so I got to thinking, and what I'm going to do for today's Money Club Mondays. And I haven't had any borrowers reach out to me wanting to be on. So I figured I would take the time today to talk a little bit about the basics of what is private money lending. Like, how do we do what we do to create passive income? And more importantly, even, what is passive income? Why is this significant? Why should you work towards having more passive income in your life? So that's what I wanted to do today. So we're going to go through kind of the basics of private money lending. And any questions you have, if you're on live right now listening, put those questions in the Q&A box. I'll answer them as we go. So anything, if you're new to the private money club, you're in there, you're looking for deals, you're looking to lend, maybe you haven't joined the private money club yet, and you're just kind of learning about all this stuff, put your questions in the Q&A box, and I'll be sure to answer those as we go here this afternoon during Money Club Mondays. And if you're watching the recording, reach out to me. Any questions you have, if I can help whatsoever, just shoot me an email, Nagy, S-Nagy, at themoneymultiplier.com or at chrisnoggle.com or at flipoutacademy.com, whatever email you have for me. Reach out to me or send me a message on social media, and I'll answer those for you. So with that being said, let's dig into this a little bit. So, all right, so what is private money lending? So private money lending is essentially being a bank and giving somebody a mortgage, basically, right? I mean, so at the end of the day, there's two different types of people that we serve in the private money club. All right, so these are my artistic skills. You guys didn't know I was an artist also, but I am. So, all right. So in the private money club, we have two different types of people. All right. There's two different, and this is with everything, right? So what we do is we always want to create any business I've ever been involved with, any business I've ever helped start or run or do anything with. It has to involve a level of creating a win-win situation. All right. So we want to create win-win situations. And the reason we want to create win-win situations is because we can create win-win situations. It's just going to make everything better for everybody that's involved. And it gives you a reason to do stuff, okay? Because there's a lot of ways to go out there and make a shitload of money. But if you're running people over in the process of it and you're not actually helping lift anybody or do anything good for anybody else, then great, you made a bunch of money. But at the end of the day, you might be a miserable person. Money doesn't buy happiness, they always say. Money's the root of all evil, things like that. Well, money in the hands of the wrong type of people, or money with the one pursuit of just making more money, I can agree with that stuff. Like, what is it at the end of the day really accomplishing? But if we can make a lot of money while making an impact on other people's lives in a positive way, what's wrong with that? Are you okay with that? So that's what we really wanted to create with the Private Money Club, really with everything that we do, but especially with the Private Money Club. Okay, we create these win-win situations. So what do we got going on here? Well, within the Private Money Club, there's two different types of people. So we have people that have money, and then we have people that need money. All right, let's talk first about the people that need money. So for somebody that needs money, think about this for a minute. Why would somebody need private money? All right, and what I mean by need private money, again, Private Money Club right now is strictly real estate. So why would this person need money for a real estate deal? Well, maybe they're going to take this deal and they're going to flip it. Maybe they're going to rent it, long term, or even Airbnb. And within the strategy, the rent strategy could be BRRRRing it, which stands for buy, rehab, rent, refinance. Okay, so that's a long-term rental, just as a different strategy of financing. And we'll talk about how a BRRRR strategy plays into private money here in just a second. All right. So Mary said they won't qualify with a bank. Perfect. All right. So this person over here that needs money for, let's just say, a flip. Let's just do a flip first. Okay. So they don't qualify. Okay. So they don't qualify for traditional money, right? Like a bank mortgage or some kind of loan from a bank, a traditional bank. And really, this could boil down to a bunch of reasons why. Maybe they just got out of a bad situation and their credit score is down. It doesn't mean they're a bad person. Why is their credit score bad? Why won't the bank qualify them on that level, right? So it could be credit. Stuff happens in life. People get divorced, things like that. It can kill your credit score. But if you need the money for a flip and they won't, that could be a reason. B, maybe down payment. C, multiple properties. Because if you're doing 5 deals at a time, and let's say each deal requires $20,000 down payment, I mean, 100 grand, now you got that out there. But if you just borrow that privately, then why not? All right. So don't qualify traditionally. And these are all different reasons why you might not, and along with this would be, debt to income. So debt to income ratio might be off because you're doing a bunch of properties, things like that, or speed, time. So a bank, so speed of money. Because if this guy has a deal on a house, and let's say they need to close on that deal to be able to get it in 2 weeks, all right, 2 weeks, right? How long does it take to qualify for a traditional loan from a bank? 60 days on average. So if you need that money in 2 weeks, and up here you got to wait 60 days, okay, then we're going to need the private money. Because how can you close a private money deal? Within a couple days, not a couple months. So we can get that done very, very quickly, right? So multiple deals, the speed of the money, the qualifications, there's a bunch of reasons why somebody might, and just ease of use, really. I mean, because when you're qualifying this way, especially if you're doing deals quickly, like every 3 to 4 months, you're turning them over. It's just a lot of time, a lot of paperwork, a lot of hassle you got to go through every single time. Where with private money, we can develop that relationship. We can get the deal done and financed in 2 days. We can move on to the next one. We can get rolling with it. So the speed and really becomes very, very important right there. And just the efficiency of all of it. Efficiency is a big reason right there. So there's a lot of reasons why. Okay? So that's the why. So those are some reasons why somebody would need private money. All right, so let's talk about the person that has money. The person that has the money, why would they want to lend the deal to somebody that needs the money? Okay, so if I have money, first off, let's talk about where my money is. All right, so this is important because this came up yesterday in my conversation. So first off, where is the money? What do you guys got? Okay, money in a policy. Okay, perfect. Okay. So they have the money sitting in an IBC, specially designed and engineered whole life banking policy. Obviously, a lot of our students and clients and followers have money in these because it makes all the sense in the world to flow the money through there first. which we'll get into at another time. That's not today's training. Okay, so once you pay off all your debt, once you purchase major purchases that you need, you don't need a new car, you don't need a boat, you don't have any big trips or anything coming up, or expenses on a house rehab or investments or anything like that, that you're doing yourself. So you got money sitting there. Remember, money sitting still is losing money. Money in motion is making more money. So very important to keep that money moving, even though it's in there compounding for you. Okay, so maybe money in a savings. Maybe for whatever reason, you haven't moved the money over to a policy yet, but you do have money sitting in a savings and checking account. Maybe you sold out some stuff. A lot of people right now have sold. Why have they sold stuff right now? Whether it's housing, whether it's stocks, a business. Why have people sold here lately? Because the market has been through the roof. Appreciation has run wild, right? I'll give you a great example of this. My cousin, who I've done a lot of business with in the past, and he's become a humongous proponent of the Private Money Club, because I introduced him to the Private Money Club last year, and he's now lent out a ton of money on a bunch of different deals in the Private Money Club to a bunch of different investors, and he's loving it. He's bringing in thousands and thousands of dollars a month completely passively. So he's out there talking about it. But before that, he had his money. He's starting to transfer the money from here into here now. But prior to getting all this going, he had a lot of money sitting in savings accounts and checking accounts. Why did he have money sitting there? Well, because in 2010, him and his dad were very smart. My uncle, they were very smart, and they purchased a bunch of real estate in Southwest Florida right after the 2008 crash. And if you guys remember, one of the hardest hit areas in the entire United States of America was Fort Myers, Florida. So there was a ton of deals available, all the foreclosures and everything else. So they were able to pick up something like 120 to 150 houses, different doors, over that few-year time span that they kept as rentals. So those rentals have been paying them rental income over the last decade. But also on top of that, not only have they had rental income coming in that they've lived on, but more importantly, they've had a lot of appreciation, because that's one of the beautiful things about real estate investing. Is not only can you flip it and make quick gains now, not only can you rent it and create mailbox money, passive income, but you can also have all kinds of tax breaks, but more importantly, you get the appreciation of it all, right? Especially when you buy it low, like after a crash, like after what's coming up in the next couple of years, in my opinion, we're going to see another downturn. But let me keep going with this. So they were able to purchase a bunch of homes. So over the last decade, they've kind of figured out which houses did they buy way down here, which houses appreciated the most, and which houses are giving them the biggest headaches, meaning have shitty tenants, they're in bad areas, they've appreciated, they have nice income from rents, but they're just not worth it. So those are what we call, let's sell off the worst part of the portfolio. So that's what they've been doing over the last couple of years at the height of this market. They've been selling off all these properties that have appreciated 3, 4, 5, 6-fold, have decent income, so it makes them very valuable to another investor. They just don't want to deal with them anymore. They're done with them. A lot of them, it's just the area that they're in. They just don't want to be in that area anymore. So they sold off a bunch of real estate. But what do you do once you sell it off? Now you got money just sitting there. Money sitting is doing nothing. So what they do is they take that. What are the options? Think about the options are for you right now. Well, your options are CDs, annuities. I mean, I'm trying to think of like safe, almost guaranteed investments, right? Treasuries. I mean, treasuries, but nobody wants to buy $1 million in treasuries. I mean, so the options are limited. If you want to be safe with it, not risk it. I mean, the stock market's at all-time highs. The crypto market, in my opinion, is still very volatile and risky right now. So it makes all the sense in the world to do this private money lending. So let me keep going with this. So where's the money? Savings. How about an IRA, retirement accounts? And Moki put on here self-directed IRA, Chuck with SD IRA. Absolutely. So a self-directed IRA is just an IRA. So an IRA is an IRA is an IRA, whether it's a 401k, whether it's a SEP, whether it's a simple, whether it's an HSA, they all have their own little rules and contribution limits and things like that. But at the end of the day, they're tax advantaged accounts that if you follow the certain rules, you'll either get tax deferred growth or tax free growth, depending if it's a traditional retirement account or a Roth retirement account. And it's self-directed just means that what your options for lending, it opens up your options. So like an IRA at Fidelity or Charles Schwab or something like that, those IRAs, they're going to allow you to invest in funds in the stock market. But an IRA at Horizon Trust Company, for example, a self-directed custodian, they allow you to invest in the stock market and all that, but also they allow you to invest in real estate, do private loans, invest in business startups. You know, Peter Thiel, one of the co-founders of PayPal, you guys can look this up, Google Peter Thiel Roth IRA, but he has a Roth IRA with over $5 trillion in it, or some ridiculous amount, maybe it's 5 billion, but it's a lot of money, right? And less than 10 years or 20 years ago, 2 decades ago, that thing had $2,000 in it because he put the $2,000 in a smart investment and $5 billion. So now he's $5 billion in a Roth IRA that he never pays taxes. He paid taxes on the 2,000, never paid taxes on $5 billion in growth. So that's what a self-directed account allows you to do. But the thing with a retirement account is once you self-direct it, now you got to actually invest it yourself. So you got to make these decisions. So that's where private money lending can become a very, very great idea for doing that. So retirement accounts, and then number 4, and I think this one is overlooked sometimes. And this came up yesterday when we were all talking. So I want to make sure I make this clear. Helocs. So a HELOC is a home equity line of credit, or even a home equity agreement, something called a home equity agreement, which is tapping into your equity without actually having a line of credit attached to it. It's basically giving you the money, and then they share in the gains later on when you sell. Which, by the way, we work with a company that teaches that. The guy's name's Matthew Sullivan. He's going to be joining us for our next 3-day Money School Essentials training. So I know we just ended the one in July up in Buffalo, the live event. This next one in November is going to be just virtual again. So we're going back to just virtual, 3 full days. And we're bringing in all the best experts from the last 2 years for this one. So Matthew Sullivan will be joining us on our 3-day Money School Essentials training in November. So make sure you keep your eyes open and get a ticket for that. It won't sell out because it's virtual, but we'll run little specials and things like that. So make sure you get a ticket whenever you see us run one of those specials for it. All right, so HELOCs. That could be an excellent source of money to do private money lending with. Okay, a lot of people don't even realize they have money because they got an old 401k, but they didn't know that they could do this with it. Or they got money and equity in their home, but they didn't know they could tap into it and use it for stuff like this. So a lot of times just understanding what you have and then what's the best way we can use what you already have. Does that make sense? So that's what we do a lot of the times on some of these different calls that we do with people. But all right. So what I mean, let me just explain the HELOC just a bit further, because I do think this is important. So right now, real estate over the last 2 years has just gone crazy, through the roof. Prices across the entire country are way up right now, right? So if you bought a home 3 years or longer prior, odds are you have decent equity in your home right now, okay? So to tap into that equity, you have 2 options. You can do a cash out refi, or you can do a HELOC. So a cash out refi is basically refinancing your property at another interest rate, starting the mortgage over, all that stuff. But you have extra equity in there. So when you refinance it, that extra equity that's in there, they give it to you in cash. So you're refining at a higher price, but they're giving you the money now. So if you refi and get $100,000 out, now you got $100,000 sitting in a savings account. Again, now what do you do with that money? So that's how a refi would work. But a HELOC, what happens? Actually, I'm going to do a real example that we talked about yesterday. Let me just do the math on this. All right, so let's say you owe $250,000 on your house. So you owe $250,000 house. Value $600K. This is pretty common right now what people have. All right. So we have equity. What is that? 350, 450, 350,000, right? All right. So we have equity of $350,000. Let's just go conservative. Let's say they give you 80% value on a HELOC, or 70. What are you guys seeing right now? I don't even know. I haven't done a HELOC in a while. Let's just say 80% for sakes. All right. So 350,000 times 0.80. So let's say they'll give you 280,000. Let's just say 250,000 they'll give you in a HELOC, but that's like 75%. So the bank is willing to give you a HELOC, $250,000 HELOC, which means you're now going to have a bank account Yeah, Todd, thank you. Up to 90%. I'm just being very conservative here. Okay. So what happens here is the bank is now going to give you a new account at the bank, essentially called a line of credit. The way a line of credit works is that money is available to you. So you have $250,000 available to you. You don't pay for that line of credit unless you use the money. So if you pull $100,000 out of it, now you're paying interest on $100,000. If you don't pull anything out of it, you're not paying interest on anything. It's just sitting there available to you. So you don't pay until you use the money. All right. So let's say that this HELOC, they're going to give you a 5%, right? 5%. So what that means is anytime you use money from this line of credit, you're going to pay 5% interest back to the bank annually. And typically they're going to make you pay monthly payments on this. Now we got a HELOC. We have $250,000 ready to go for us, ready to be used if we need it, right? Now, before I show you how we're going to use this money and what it's going to do for you, let me ask you, prior to opening this HELOC, what was that equity in your house doing for you? All right. So you owe $250,000 in your mortgage. Your house is worth 600 grand. You have 350,000 in equity. It's a good feeling. You feel good about it, right? But what is that money doing for you otherwise? I mean, it's in your rafters, it's in your walls. And this is literally cash, right? It's not doing anything, just sitting there. So we have 50. So we agree that this is doing nothing for us. So why not tap into this? Now the money's sitting there in our line of credit at the bank, just sitting there. What is it doing for us? Just sitting there. Nothing, right? Because it's not going to actually do anything positive for us until we move that money and have it making more money for us. So what are our options? What we could do with this? Because remember, as soon as you pull that 250 out, you're now going to be paying 5% 5% returns. And with most HELOCs, you're going to pay monthly interest only repayments back into the line of credit. So let's do the math on that. Let's say you take the 250,000 out times 0.05, 12,500 divided by 12. So about 1,041. So as soon as we pull that $250,000 out, we are now going to have to pay the bank back $1,041 a month towards the interest only repayments of this loan. Okay. So we pull the money out. Now, what are we going to do with it? All right. So if you invest in the stock market, let's say you're trying to, buy when the market's down. Let's say the market comes down right now. You think it's going to go back up. You buy, now you got to wait. Now you got money going out. You're waiting for the appreciation. So you're going to some point sell. What we really want to do is we really want to find something that'll help us cover this monthly interest repayment. All right. So let's go back over to real estate for a minute. Yeah. Maybe you use the money for a flip and you just kind of float the money for a while. But maybe you're not active and maybe you don't want to actively buy rentals for whatever reason. I agree sometimes like rentals just aren't always like the easiest, right? So, maybe you just don't want to be involved with that. So maybe you look at a business, right? But a business can take some time to get going and get up and rolling. So we want to be very smart with this money. So one move would be, let's run it through an IBC policy, pull it back out. And we can get to that. But let me just keep it basic, just private money lending here, okay? Just keep this very basic. Let's take this money. And so what we do is we say, okay, well, this person over here, they are wanting to go do a flip, or they are wanting to go buy rentals and do the BRRRR method. I don't want to do this, but I know that I want to make money off of my money, but I don't want to do the work part. So what if, remember, we went over all the reasons why this person needs my money. So what if I just take my money and I lend it to them so they can use it to go do all this work? And for me, solving their problem of needing the money, they're in essence creating their win. They are then in essence solving my problem of not knowing what to do with my money, creating my win. Because what are they going to pay me for me lending them my money? Well, they're going to pay me anywhere from 10 to 15% interest. So this person over here is going to be willing to pay me 10 to 15% for me to lend my money to them. All right. And I'll show you in just a second how this is safe, how it's protected, what happens if they don't pay you back and stuff like that. All right. But just stick with me here for a minute. So what did I just accomplish here? I take my $250,000 that was previously sitting in my house, doing nothing for me. I find somebody to lend it to, and then I lend my money to this person. Okay. They now have my $250,000. Now, as soon as they get my $250,000, they have agreed, let's just take the average. They've agreed to pay me 12%. They agreed to pay me 12%. So what's going to happen now? All right, so the 250,000 is now here. Okay, this is the need. Okay, that's the person that needed the money. They now have my $250,000. For me to give them that $250,000, we do just what a bank does. When you go get a mortgage, why does the bank lend you money on that mortgage? Because the bank is securing that loan through collateral. What is the collateral? The house. Okay, so the exact same thing. When I lend them this money, my money's secured through a mortgage or a deed of trust. And ideally, especially with larger sums and depending on the deal, but ideally speaking, in a first lien position. Now, there's situations and cases why it would be okay to lend in a second lien position, but for the case of simplicity right now, lend in a first lien position only. We'll just keep it simple for right now, okay? Why do we do that? Because that's what the banks do, because this secures our money. So what this means, so this along with what's called a promissory note, okay? So the promissory note connects to the mortgage or deed of trust. The promissory note has the terms. So the terms, 12% annual, let's say interest monthly, let's say 12 months, okay? So we can get into more of those details, but just some of the basics of what the terms are. So they're willing to pay you 12% annually. They're going to pay you interest payments monthly. You're going to get the return of principal at 12 months. And most often, there's going to be no early payment or anything like that. So you might get the money back in 6 months or 8 months or whatever. You know, are there points? So those are the terms. So this PN is connected to the mortgage, and the mortgage states that the deed of this property is this person's deed. But if they don't pay the mortgage broker, who is you, the person lending the money, then you get to foreclose on that property. Or if you write it up in the contract where you just get to take over that property if they don't fulfill on the promissory note the terms of that deal. So just like a bank, when they foreclose, when somebody doesn't make their mortgage payments, you're able to do the same thing. When they don't pay you, the property then becomes yours. So your money's secured, because the only way you're going to lend the money to this person is if this is a good deal. Meaning, let's say that this house is worth 200K and they're buying it for 80K, 20K in rehab, and the ARV is 200, right? So if they need 100,000, so if they need 100,000 and the house is worth 180 to 200,000, depending on how much work was done, well, that's okay. Because if I give them 100 grand for the deal and then they disappear and go away, then I take back the property, I sell it to wholesale it for 120. I still made 100. I still made 20 grand on the deal. My money was secure the entire time, so it's protected. So you're going to protect your money just like a bank does through the mortgage deed of trust. Does that make sense for everybody? But let's go back to the HELOC. So this is what we're doing to be willing to lend our money, right? So we got this HELOC, and I just said that they're willing to pay us 12%, right? So let's do the math here. HELOC, lending, income, profit. Okay, let's do the math. Who's helping me out here? So the HELOC payment again was $1,042. How much are we making from the private money loan? So 250,000 times 12% divided by 12 months, 2,500. 2,500. So what's the math there? Minus 1042, 1,458. And this was a real situation I talked to my brother about yesterday. He's got a lot of equity in his house. So I was like, what is that money doing for you right now? And him and his wife were like, well, nothing. All right, so check this out. So I showed him this. Take the HELOC, say 5%, whatever it is. The private loan's 12%. What is that called? That's called a spread, right? This is how banks operate too. When you deposit your money in a bank, they pay you 1% in a savings account, and then they give somebody else a mortgage at 5%. They're making a 4% spread. Same thing with the car note. They give you 1% in savings, or 2% in a CD, then they lend that money out on a car note to somebody at 6%, they make a 4% spread. So same thing here. We're borrowing the money at 5%, we're earning 12%, we're making a 7% spread on money that otherwise would have been doing nothing for us. So how many of you, let me ask this question, how many of you could use an extra $1,458 a month coming in for doing an hour or two worth of work. Once the HELOC is set up, which you might have to go through an appraisal or something, I don't know. But let's say it takes a couple hours to get the HELOC established. It might take a couple hours to underwrite a deal. Although once you build the relationships, it takes 5 minutes. But let's say it takes a couple hours. So we're a few hours in and we got $1,458 a month coming in profit for literally doing nothing. Worst case scenario, this investor disappears. What do we get? We get that property that we lent the money on free and clear that we can do whatever we want with. You know, maybe the market tanks and it takes a little bit, or something goes wrong on the deal. Well, just extend it to them or have a penalty worked in there where if they don't pay you back and they need to extend it, they give you an extra couple points. So there's a lot of different ways we can do this to protect ourselves and make sure it does become a win-win situation. But my point is who want to make an extra $1,458 a month on something that otherwise was doing absolutely nothing. So a HELOC is something not to overlook. And then, you know, we talked a little bit about, you know, like 401ks, for instance, like an active 401k at work. You cannot move to a self-directed account typically. You're kind of stuck. It's got to be like an old 401k or IRAs and stuff like that. So what do you do with an active 401k? Because a lot of people think the stock market's going to continue to decline. So why keep the money in the market if it's just going to continue to decline? I get dollar cost averaging in on the way down, but I think we're going to see some steep declines. So wait a little while, you know? So what do you do? Well, in the 401k, I mean, you can always do a loan. So you can do up to $50,000 in a 401k loan. So that could give you an extra 50 grand that you can lend out on something. So just thinking about where your money is and how to be smart with it. And on a 401k loan, you pay yourself back like 2%. But that goes back into your 401k, but your spread becomes even larger because you're paying 2 on that. You're getting 12. So your spread's even bigger. It's a smaller amount, obviously, at 50,000, but at least that gets your money out of the markets and into something that is going to create and generate some income for you for right now, which is kind of cool. So different things like that we can start doing. Those are some different places that people have money, some reasons why people need private money to make this work. All good stuff, right? Any questions on any of that? I know Drew wrote a question. Let me read it here. And then I'm going to get into types of deals. All right, types of deals, because this is important too. All right, so Drew said, so I've done a few deals now, but part of me feels like any deal that I participate in should run through a policy. However, I'm a bit nervous to over committing to policy premiums on a yearly basis. Business is good, but understanding that we're on the cusp of a recession, hard to judge. Is business going to stay booming over the long term? Would be curious on your thoughts on how I should be thinking through things with the profits I'm making. How much should run through a policy versus not keeping your cash on the sidelines? Yeah, that's a great question, Drew. You know, so what Drew's saying is, you know, let's say his income is 500K this year, but he's scared that because his business runs off of people doing well in the economy and things like that. And I'm not going to get into what Drew actually does. I'm just using a hypothetical here. I don't know if Drew actually makes 500 grand a year. I'm just hypothetically speaking, but so let's just say he makes 500 grand, his business is booming, you know, so he's like, you know, like I'm comfortable running 200,000 a year through policies, right? But what if his income drops to 200,000 and then he's only comfortable running 50K through policies? So he's asking me, should he continue to open policies on what he's making today, getting a larger amount in, or should he only get in there today what he feels like in the future might happen to him? And I don't know, Drew, that's actually a good question. You know, it's if you can copy and paste that and put it in for Ask Me Anything on Wednesday, I would like to hear the whole team's thoughts on that. Because, you know, when it comes to the whole life, it is flexible. You know, when we start a whole life, if you started at 100,000 a year, you can always drop down to about 25 to 35. You can always drop from there to there annually, and the policy will be fine. It'll remain in force. You're just not going to, especially in the early years, you're not going to get as much oomph and growth as if you were maxing it out. But you can always make up for this oftentimes a year or two later also. So, you know, if you feel like, hey, I'm making good money now, I might have a few years where it's a little bit less, but then at some point it's definitely going to come back up. Then, you know you have that safety net. But if you feel like it might come down and then it's just going to stay down, you know, that might be a little bit different of a situation. So it's definitely something Drew, that I don't think there's one answer for it. You know what I mean? But definitely copy and paste that. Let's talk about on Wednesday with the whole team, because I'd love to hear their thoughts on it too. And I have been getting that question more and more lately as people start to think about where are we headed right now with everything. And if you're not familiar with whole life and the infinite banking concept, join me tomorrow at 6 p.m. I do a whole introduction presentation on what infinite banking is, privatized banking, how it all works, how to get started and all that good stuff. So at 6 p.m. Eastern tomorrow, join me on Zoom and I'll do that whole presentation for you so you can learn more about that. But basically it's just running the money through the policy and then doing all the same stuff. But by running it through the policy first, now you have uninterrupted compounding interest while you're also doing all the private money lending and everything. So you're getting double growth on your wealth as opposed to just running it into a savings account. And then when you pull from the savings account to do private money lending, you get zero over here. So you get the private money lending growth, but with the policy, now we get double growth on everything. And the growth within there is tax-free and there's all kinds of advantages. So that's all it is. But yeah, I can get more into depth with it tomorrow. All right. That's a good question, though, Drew. I have been getting that one more and more. Dylan said, my HELOC is my largest pool of capital as I'm capitalizing my policy. One of the biggest issues I've run into since I've started private lending is finding a competent tax advisor. I just met with 20 plus tax accountant 20 year, and she said she doesn't feel comfortable advising me due to my private lending, note investing. Yeah, Dylan, I mean, like corporate capital is pretty good with that stuff. If you want to talk with Brent Carlson, if you want an introduction, Dylan, send me an email and I'll hook you up with those guys. So the other thing real fast, just because Dylan brought up the HELOC and Drew's talking about, before I get into types of deals. So HELOC, so you could just do the private lending thing that I talked about before, make the 7% spread, okay? Or what we can do is we can run it into a policy, run it through the policy, and then do a private money lending deal. The only difference is it's going to reduce the spread that you're getting now, but it's going to build more for the future. Okay. So let me explain real fast. So if we run it this way, private money deal is 12%. The HELOC is 5%. So that's why you're making the 7% spread. Over here, you're running the HELOC to the policy to the private money deal. Now you're making 12% of the private money deal, but when you pay back the policy, you're paying the insurance company 5% on the loan, and then you're also paying another 5% back to the HELOC. So your spread basically goes from 7% to 2%. Now, with that said, that's in the early years. And when you start a banking policy, one of the things that you always want to do is capitalize it as much as possible. So that's why Drew is asking, should I put a lot more into my policy now, knowing that in the future I might not always have it? Nelson Nash would tell you yes, actually, Drew, now that I think about it. Nelson Nash says over and over again, do not be scared to capitalize. Because if later on your premiums deposits are higher, maybe your income is lower because we're in a recession. But if you capitalize your policy enough in the early years, you're going to have plenty of cash value in there that's compounded to take loans to cover the premium deposits until you get back on your feet a few years later to not only make up for it, but also continue with the higher amounts. So Drew, that's probably what Hannah and people will tell you. You know, Chris and myself might be a little more conservative, but don't be scared to capitalize. And this is a great example of that because, you know, even if we're making a little bit less money now, you know, 2% for 7%, but getting $100,000 in this policy right here, getting this in here, what does this do? What does this create? It creates uninterrupted compound interest. So this $100,000 is now compounding uninterrupted tax-free for the rest of your life, even while you're simultaneously pulling it out and running it through these private money deals. So we're getting more money in up front that's going to compound for us for the rest of our life. When it comes to whole life, a policy you start today is always going to be the cheapest policy you ever own. And the reason for that is because the cost of insurance on whole life is level. So if I start a policy today at 39 years old, when I'm 90 years old, my cost of insurance is still like I'm 39 years old. It's level for your lifetime. But if I start a policy at 70, now my cost of insurance is a 70-year-old, so it's higher. So that policy will never be as efficient or as effective as when I'm 39 years old. So if I can find as many ways as I can right now to get as much money into this policy, even though I have less monthly now money to spend and do stuff with, what I'm doing is I'm building for the future. So I'm taking advantage of what I have access to now to build up my banking system. So down the road, I have a lot more money that I can do private money lending with. I love it, Dylan, what you're doing. I mean, it's a great strategy. I'm a big fan of it. And just so you know, if you dump $100,000 into a policy, you don't have to do $100,000 every year. You can dump $100,000 in and then just do $10,000 a year moving forward. Where does that $10,000 come from? Well, maybe it comes from taking the money, lending it out, building that money back up, and using that to fund the $10,000 a year. So there's a lot of different things we can move this stuff to create the future deposits as well to get more and more policies going for ourselves. All right, so let's talk about some different types of deals. So when you go to the private money club, and by the way, I'm talking about the private money club right now. You don't need the private money club. If you go to enough RIA events, if you've been in the business, if you have friends or family, neighbors that have retirement accounts, have Helocs, they trust you. Maybe you teach them how to use those in your business by lending you money on your flips, on your rentals, on your real estate deals. You can create that win-win situation. Get their money out of the market, get their money out of the equity, get their money moving and making more money, and then they lend it to you. So you can do this on your own. You don't need the private money club. The private money club just gives you a platform to create these relationships, to meet these people, to find the deals, to give you the support and the education when you're new, to make sure you're doing things the right way, to help you underwrite deals, to make sure they're good deals, to give you resources and access to coaching and training and attorneys and me and my team and everything that we do. So that's what the private money club does for you. You don't need us. It just makes things easier, especially if you're new and especially if you want to really find deals that otherwise you might not have access to. So in the private money club, there are multiple different types of deals. And really the type of deal that you invest in really should be dictated by your comfort level, really. So, what kind of returns do you want? How risky are you willing to be with your money? What's your time frame of lending the money? How active do you want to be with it? Those are all really good things that you should be taking into account when you're looking at these private money deals. So let me pull up the private money club just to give you a sample real fast of what we're talking about, and then I'll go over some different types of deals. All right, so this is private money club. All right, so the beta version is going away mid-October when we launch it at the official launch party in October. So hopefully you guys are coming to that. If not, check it out. But nonetheless, all right, so when you log in, let's say you're looking for new deals. So if you need funds, posting a deal is different, but if you're investing, all you do is go in here and start looking at deals. So we can see on here, it's the first deal on the private money club. He's looking for $130,000 at 15%. He's 90 grand. This was a rude deal. This one's actually gone. I don't know why it's still on here, but this was like 70 acres at $245,000. This was funded on Friday. This was 15%. So you can just go through and look at different deals. $70,000 at 12% needed. These are some different little micro loans. So if you only have $20,000 to loan, that might be a good one to look at. $10,500, so a real small amount. That's kind of cool. So you can see, anywhere from $10,000, $190,000, $413,000. And by the way, this was just because I know this deal, they needed $413,000 total, but they have multiple lenders on this deal. So somebody had 50,000, somebody had 100,000, somebody else had 60,000. So there's 70,000 left needed. So just so you understand, that's why that's 70. But all of you would go on as first lien position. You would just all be proportional on it for whatever amount that you invested. So that's how that works in those kinds of deals. So you can start going in and you can look at these different deals. Whether it's single family, whether it's multifamily, whether it's a mobile home park, whether it's land, whether it's commercial property, it's all, maybe that goes into account what you're lending on. Maybe you only want to do single family homes, or you only want to do mobile home parks. That's fine. If you think that that's the best investment for your money. To me, it boils down to more who the investor is and what the terms of the deal are. So let's talk about that for just a second, because I think that's more important than the type of deal that it is. All right. So what are some of the different terms? So obviously interest paid. So interest paid. So if you know you will not lend your money for under 12%, then you're not going to look at any deals that are offering 8 or 10%, right? If you know that you want to get 15% on your money, then you're going to look at the deals that are 15%, or maybe it's one that's 12%, but they're negotiable. Maybe it's sitting on there for a week or two and they haven't got it funded. Well, contact them and say, hey, I'm interested in your deal, but I will only do it for 15%, whatever. So determine the interest rate, length of deal. So how long do they need your money for? Is it a 3 to 4 month flip that they're going to lend, you're going to lend up to 6 months, except you're expecting it back in 3 to 4 months, very short term? Is it a 12-month deal where they're going to fix it up, they're going to rent it out, they're going to let it season for a few months, and then they're going to rehab it? Refinance it in 12 months, so you know it's going to be 12 months. Is it a 3-year deal? Okay. If you know you only want to lend, if you know you only want to lend your money for 3 to 6 months, then don't look at a 3-year deal. Or if you know that you don't want your money back in 3 to 6 months, then look at long-term, 3 to 5-year term deals. All right. So what's the length of the deal? And this all could come into play. Like, where's the money coming from? What are your plans with the money? If it's a self-directed IRA and you're my age, I know I can't touch that money until I'm 60 years old anyways, without penalty. So why not do a long-term investment where I put it in there for 5 years and I don't have to think about it? So long-term might make more sense for a self-directed IRA. But what if I have some money sitting in a policy that I know I want to use to start a new business with in 6 months, or I know I want to use to buy a bunch of real estate next year? I'm just not doing it right this second. So maybe I look for a 6 to 6 month deal. So that way my money's moving for the next 6 months, but when I need it in 6 months from now, I have it. And then the interest repayments. So is it monthly, beginning, end? So what are the monthly repayments? Most deals on Private Money Club are going to be monthly repayments, which if you're doing like a HELOC or a 401k loan, if you're doing one of these, those require monthly payments. So if you are going to get all your interest at the end of the deal, you're not getting monthly interest, you're getting it all at the end. Well, maybe that doesn't make sense because you don't have the money to cover the interest payments. So that wouldn't work. You need the monthly. So that way you can cover the spread and get the money back into there. So how does that look, right? So these are all things that you want to look at when you're looking at a deal. This probably be, the amount, of course. If you only have $10,000, there's no reason to look at $300,000 deals, especially if they're not willing to combine your money with other investors. If they want one investor, which some borrowers, that's what they want. They want one person to fund the whole deal. That's fine. It's all a negotiation, which, by the way, this is all negotiable. So if you're on Private Money Club and you see something that, again, it's 10%, but you want 15%, well, give them a shout and tell them that's what you want. Or if they're offering, interest all at the end, tell them you need monthly, because all of this is negotiable, right? All right, here we go. Last thing that I'll hit on before we wrap for the day: types of deals. I brought it up before. All right. So single family houses. So these are going to be typically your everyday investors, people like myself, people like John and Lori, who you just saw on here. Who else is doing flips that are on here right now? So this could be flips, which is what John and Lori's doing on that property I just showed you. It could be the BRRRR strategy, which is what Devin does. So this is buy. So you buy with private money, okay? Buy with private money, rehab with private money. You find a renter to go in the property, and then once the renter's in there, you refinance the deal, get your money out, pay off the investor, and then they hold the deal long term. So that's the BRRRR strategy, but it's all single family deals, right? Could be short-term Airbnb, whatever. Then we have multifamily. So multifamily could be apartment complexes, could be mobile home parks. Mobile home parks aren't really multifamily. I kind of can always consider them multifamily, but so apartments, multifamily. What else have I seen in there? How about land? Land. we see land all the time. And then land can lead into multiple things. So we saw a deal that just was on the Private Money Club. So this is 70 acres, right? So 70 acres with one mobile home on it. Right. So closing August 18th. Like I said, this was just funded on Friday. But the 70 acres. So Chris Rue, this is a Chris Rue deal, 245 grand. He has no immediate plans for this. Actually, I shouldn't say that. I'm not 100% sure. But from my understanding, he doesn't exactly know what he's going to do with it yet. But he's going to have a lot of options. But he used private money to buy it, and he's going to refinance it out with traditional financing. But why did he do that? Well, with land, there's a lot you can do. You can build a mobile home park. You can build a ranch. You could build an RV resort. You could do what Dr. V is doing. You guys remember Duck V? He raised that, what was it, like 2 million he raised on Private Money Club? He's doing a glamping. He's doing a glamping resort on like hundreds of acres out in New Mexico. So you can do a lot with land, right? You can develop, which brings me to my next type of real estate, developments. So right now we have 2 different types of developments available in the Private Money Club for lending on. So these are the two main ones. There might be more in there, but these are the 2 that we've been working with for a long time now. Millions of dollars have been flowed through, and they're doing very, very well. So number 1 is Rob Fuller. Rob Fuller with ROI Property Group. And what Rob's doing is they're buying big, huge swaths of land, and they're developing real estate neighborhoods. So they're doing full neighborhood development. Some of these are single family, like ranches, that they're going to sell straight out. Some of them are rental communities. There's one in Georgia going on right now that's a full rental community, and it's actually pre-sold already to a hedge fund that is buying rental properties right now. So the whole neighborhood's rentals. They're doing townhouses. They're doing all kinds of different things right now. So they've got a bunch of those types of deals going. So these are developments. I mean, they're going to offer anywhere from 12 up to 18%, depending on how much you lend. Again, he's got access to tens and hundreds of millions of dollars of hard hedge fund money to do these deals, but he's using the Private Money Club because it's fast. He can get the money when he needs it, not all at once. There's a bunch of reasons why he's using private money, and he's still personally guaranteeing these deals as well. So the risk is way down on these large projects, which is really cool. So this is a really good one. And then we have Jack Petrick. He develops land as well, but in a different way. And these 2 guys were on last week, if you remember. They were on last week's Wealth Webinar Wednesday. But Jack Petrick is with Florida Pro Builders. And what Jack is doing with his partners is they're buying single lots. So instead of a big piece of land and building a neighborhood and putting in roads there, they're just buying little lots that are already on developed roads, already have utilities ran and all that stuff. And then they partner with a nationwide home builder that does thousands of houses at a time to build the houses. So they're finding the land and they're building single family houses, and they're selling to a middle class first-time home buyer or somebody looking for a new home in that affordable housing range, that $200,000 to $400,000 range in Central Florida. So that's what he's doing. So both are developing land, just different types of deals, right? So just to give you a couple different ideas. Todd said commercial, absolutely. So here's another one. Private. So typically when it comes to commercial property, it's going to be either a syndication or a private fund. So that's another type of deal that's in Private Money Club. Private funds. So private funds are managed by a professional. You don't actually have like a mortgage on the property, but you have a lien on the fund, which is how your money's protected. And then the fund actually purchases all the real estate and does everything. So right now, there's a fund in the Private Money Club called Cap Flow. It's 6 to 10%, 1 to 3 years, right? Something like that. Andrew Chestnut is managing the investing of this. So if anybody wants to learn more about this, just let me know. I'll connect with Andrew. You guys can set up a call and he'll tell you all the details. But what this fund does is it buys commercial property. and they are very conservative. They only buy at like 60% or below loan to value. And they've been doing it for 25, 30 years, the managers of this fund. So they're very good at what they do. And it's very hands-off for you as the lender. You just invest in the fund. You start getting monthly, it's monthly or quarterly interest payments, 6 to 10%, depending if you do 1 to 3 years. And it's very easy. At the end of the time, you get your initial investment back and you move on to the next one. So there's private funds in the deal. And typically when it comes to commercial property, you're going to see either a private fund or a syndication. A syndication is similar to a private fund, except sometimes you have a little bit of ownership. In a syndication, there's what's called the general partners and the limited partners. And usually the lenders are the limited partners, meaning they don't actually get involved with any of the work. They just lend the money. But you know, how that gets paid out is a little bit different. Could be some equity involved. There could be more money when they rehab it as opposed to the long term. So syndications can get a little bit more involved, but they can be really good too. I mean, we've had a number of syndications in the private money club come through as well. And I talk to people all the time that are raising money. And when you get into private funds, it gets a little more, depending on the type of fund with Reg A and Reg D and all that, but we won't get into that right now. All right, so just want to kind of point out some of the different types of deals on the private money club, or when you're doing private money lending, what that looks like. I mean, for me right now, my favorites are the quick flips, get in, get out, get paid at a low loan to value ratio and a high ARV after repair. So I like the quick stuff right now, affordable housing, you know, stuff that's not like multi-million dollars and things like that. I prefer the affordable housing prices. I'll start to look at multifamily again. Just there hasn't been a lot of deals out there. Development, if you have guys like this that are keeping a pulse on the market and know what's going on and they're protecting themselves against a downturn, I'm good with this stuff too. I think it's great. I think it's a great place to lend right now, just me personally speaking. And I think some of the land can be good. I mean, some of this development can be good. So, and a lot of this is pretty cool what's going on right now with the RV resorts, some of the glamping resorts, some of the stuff that people are doing. I'm a big fan of it. I think in this economy, this market, I think that stuff will all be very, very good. So, all right, guys, I went a little long today, but I thought that was kind of an important training to do. So I appreciate everybody hopping on here. I don't see any questions coming in. So hopefully that made sense for everybody and it helped you guys kind of start to wrap your heads around a little bit about where's your money, what are some different things I can be thinking about for moving my money and getting it into some of these different deals. So if you're interested in a private money club, it's just privatemoneyclub.com. Go check it out. If you need to get a hold of me, shoot me an email or a message on social media. I'm right here to help you out. We'll schedule a call. We'll talk. Other than that, like I said, tomorrow night, 6 p.m. on Tuesday is the Money Multiplier presentation. And then we have a full schedule Wednesday and Thursday of webinars as well. So we'll see you then. Hope you guys have a great day. Have a great week. And we'll see you next week on Money Club Mondays. Thank you. Bye.